प्रेजेंटेड बाय ईबिक्स कैश। हर खुशी के लिए काफी है।
Hello and welcome. You're with us here on the Business Today show. I'm Abha Bakaya. Let's take you through the headlines. Ford to exit the Indian car market, says it will immediately stop production of cars in India, assures existing customers of continued service. All eyes on the $1 billion FabIndia IPO, but will the recent revenue slump at the ethnic clothing company impact investor appetite? Ola scooter plans hits a roadblock. Website glitches embarrass the company, forces it to postpone sales launch by a week. Indices end with minor gains in choppy trade. Airtel and Vodafone India among the top gainers. An exclusive conversation with valuation guru and Stern Business School professor Ashwath Damodharan, who has advice for investors: look for disruptors in the market.
Paytm has some real potential because I think this is a business which is huge. Payment processing is huge and financial services is huge. So if I can get Paytm at the right price, I'd prefer to have Paytm in my portfolio.
You've probably been one of its customers, buying clothes and accessories off the shelves of FabIndia. Now you have a chance to be one of its owners. The company plans to hit the market with a public issue probably by the end of this year.
It's the company which reintroduced ethnic Indian wear to the urban consumer, made handicrafts cool again, and most importantly, connected tens of thousands of rural artisans to their customers in cities. Now, the company is going public, raising money for expansion and to reward those investors who believed and invested in it over the years. FabIndia is expected to file for a public offer by the end of the year. It has appointed 5 bankers to raise as much as $1 billion via the issue. FabIndia is the brainchild of American John BISSELL, who wanted to export home furnishings from India. His base was his residence in Golf Links, Delhi. Born in the US, BISSELL moved to Delhi in 1958 as a consultant for the Ford Foundation. The job introduced him to rural handloom workers, and in 1960, he incorporated FabIndia. The big break came a few years later when he tied up with the British company Habitat and the Bharat carpet manufacturers. The deals allowed FabIndia to export woolen rugs and furniture to customers in the UK and US. Its first Indian store opened in Greater KAILASH, Delhi in 1976. 5 years later, FabIndia started ethnic wear. 2005 saw the company step into online sales, and today it sells in 15 countries. 2008 saw the introduction of jewelry. Today, FabIndia operates more than 300 stores across India and overseas. The FabIndia model attracted some high-profile investors like Azim Premji and Infosys co-founder Nandan Nilekani and his wife Rohini.
There are some concerns though. The company has been particularly hit because of the pandemic, and with its stores shut and customers staying away for almost the first half of this year, the company has seen its sale plummet. The company, however, at the moment is believing that investors will overlook the pandemic and invest in its future. This is Aishwarya Paliwal reporting for Business Today with camera person Ashwini Helen.
Markets consolidate, trading in a narrow range. On Thursday, they saw some amount of profit booking at higher levels, keeping the upside capped. The Nifty 50 hovering within a 75-point range in intraday, finally closing the session marginally higher, as you can see. And the sensex also just up a notch. 58,305 is where we ended up for the day. ONGC, Bharti, Airtel, Nestle, Hindalco, some of the gainers. Add Grasim to that list as well. Strong gains coming in, particularly on ONGC and Bharti today, 2.5%. And on the downside, HDFC Life, Titan, Ultratech, we had Bajaj Auto, some of the stocks that brought up the losers list in today's trade. Markets will remain closed on Friday on the occasion of Ganesh Chaturthi. We have a special treat for you today, an exclusive conversation with a guest who is in a league of his own. I earlier spoke to Ashwath Damodharan, a valuation guru and a professor at the Stern Business School in New York. He had a lot to say about what investors should do in the stock market at current valuations. Let's listen in. Professor, great to have you on the show and have an opportunity to once again catch up with you on all that's happening, and particularly with markets at these consistent records. We know it's backed by the Fed's easy money policy, but nonetheless, it's surprised everyone. Retail investors in particular are wondering, have they missed the boat this time around? What does a retail investor do, Professor, at a time like this?
I'd like to first get rid of this distinction between professional investors and retail investors, because implicit in that distinction is somehow the belief that professional investors know what they're doing. I mean, I've had 40 years dealing with mutual fund managers and hedge fund managers, and trust me, they're just as ignorant and just as driven by greed as retail investors are. So rather than think in terms of what retail investors need to do, let me talk in terms of what investors collectively need to do.
Okay.
I think one of the first things you need to decide when you come into the market is why you're in the game. Are you in the game to preserve and grow your wealth, which is investing? Are you in this game to make money quickly, to get rich, which is trading? Are you an investor or a trader? And every person coming into the market, professional or retail, has to make that judgment first before they decide what to do next. So in this market, I think this is a trader's market. Investors are going to be shut out, but don't lose faith. Your time will come.
And that leads me to my next question, because you've been a proponent of value investing, and I know over the last couple of years we've also discussed how perhaps the old metrics of value investing have changed, low PE for example and so forth. What does an investor look for today? Do they go for growth? Do they look for other metrics to define what perhaps makes a good investment?
The first thing is we need to realize that when you use a metric, you're using a shortcut, right? When you use PE, price to book, any multiple, using a shortcut and hoping that it gives you undervalued companies. I think increasingly we live in a world where those shortcuts don't work. The alternative is, and you're not going to like what I say, requires that you do the hard work of assessing what value is and where it comes from. And that's a much richer question, because value can come from not just earnings last year or earnings next year, but it can come from growth, it can come from the cash flows you generate as a business. You can be a value investor and buy a young growth company that's money losing. I know that sounds contradictory, but a young money losing company at the right price is a much better investment than an old mature money making company at the wrong price. So I think we need to expand our definition of what value is for value investing to make a comeback.
Okay, so let's talk about some of the big tech listings and IPOs that we're tracking here in India. We all were looking at your comments and monitoring them, and there was quite a bit of debate around it, particularly when Zomato was going in for listing and seeing those prices ahead of that as well during the IPO period. But it's not just Zomato. We're heading into a period where we have Nykaa, Policy Bazaar, Ola, companies with $3 to $4 billion of valuations that are going to be hitting the market, and that too this year. It's going to be pretty busy. Is your skepticism across the board at tech companies altogether? Was it limited to Zomato? How would you view this space?
Yeah, I almost never extrapolate beyond the company I'm valuing, because the danger of extrapolating then you get sloppy. You say, look, I'm not going to buy a tech company because all tech companies are overvalued.
Right.
So I plan to look at tech companies one by one, and I'm always open. I never say never. So when I look at a Zomato, for instance, I'm never going to say, no, I will never invest in Zomato. At the right price, I would obviously invest in any company. Which means due diligence requires that when I want to look at a stock, I've got to look at that stock, not make a judgment about a whole group of stocks.
Okay. So
I do think that we're in a period where IPOs are more likely to be overpriced than underpriced. But that doesn't mean that one of them might not make it onto my radar as a fairly valued company or an undervalued company.
Okay, so keep those big IPOs on the radar then. And do you feel for retail investors who have a shot at perhaps being allocated some of those shares, that they should wait in general post a listing so that the euphoria at least has died down a little bit and valuations are a little bit more reasonable? Is that a fair strategy?
No, that's not an unreasonable strategy because across the world, when companies first go public, the traders rule the game, right? That was true in the US, it's true in India, it's true in China, it's true in every market.
Yeah.
Which means it's mood and momentum that drives day-to-day price changes. I've discovered that mood and momentum can shift in a moment. I remember when Facebook went public and I valued Facebook and I said, I think it's overvalued. 3 months later, the stock had halved in value and it's been in and out of my portfolio since.
Okay.
The same thing with Uber. At the time it went public, it looked overvalued to me. 4 months later, it was cheap. So what I would suggest is if you really like a young growth company that's going public, whether it's Paytm or any other company, value the company. You don't have to jump in at the time of the IPO. But keep revaluing the company because one of these days it'll make it back onto your radar as undervalued. Never give up on a company. Think of it as a work in progress where you're valuing the company, the market's pricing the company, and you're hoping to get it at the right price.
You mentioned Paytm. I'm curious to ask you about, whether it's fintech, whether it's Ola in the auto space, Ola with its big EV play. There are, these companies that are now chipping away at the older listed behemoths in the space, whether it be finance, whether it be auto. Do you see that as a trend that's going to continue to grow as some of these tech majors start to contribute more and more to the market cap percentage of GDP?
In some sectors, yes. In fact, there are two things I look for sectors that are likely to be disrupted. One is I look at how big the market is. Financial services, obviously a huge market. Automobiles, a huge market. But the other thing I look at is the existing status quo. I mean, one indicator that a business is going to get disrupted is if nobody's happy. Customers are not happy, companies are not happy, regulators are not happy. And let's face it, that's the state of the game right now in financial services and automobiles. Nobody's happy with the status quo. And when nobody's happy, you're open for disruption. So I think there are sectors where I think disruption is going to come simply because the existing way of doing things is no longer working. It hasn't worked in automobiles for about 30 or 40 years. I'm waiting for airlines to be next on the list because I know airlines have not worked for 50 years across the world. People can't figure out how to run a money-making airline. So you're going to see disruption coming to those businesses where the existing way of doing business is no longer working.
I know I'm pushing you on this. I know it may be a little ahead of time, but Ola or Paytm, which one would you buy?
Depends on how they get priced. I mean, I would prefer Paytm to Ola because the ride-sharing business is a complete disaster around the world. I mean, ride-sharing is one of those businesses where they figured out how to grow, but nobody seems to have figured out how to make money. And it's not just Ola. It's Didi, it's Grab, it's Uber, it's Lyft. None of these companies have figured out how to make money, partly because there's no stickiness in the model. What I mean by that is I have no loyalty to Uber or Lyft. I'm going to take whichever one is cheaper. And the drivers have the same view. Paytm has some real potential because I think this is a business which is huge. Payment processing is huge and financial services is huge. So if I can get Paytm at the right price, I'd prefer to have Paytm in my portfolio over Ola.
Catch more of that interview online at businesstoday.in. We spoke to Professor Damodaran on crypto, other millennial themes, and his outlook on some of the other big tech IPOs this year. TCS has signed a 10-year deal to upgrade the Taxi and Private Hire Vehicle Licensing Administration in London. TCS will design and launch the new system, which includes an on-demand data and records management system. This will ease services like licensing payments and refunds to vehicle operators and owners through digital channels. The Supreme Court has upheld a 2,800 crore rupee arbitration award in favour of Anil Ambani-owned Reliance Infrastructure. The Apex Court dismissed an appeal by Delhi Metro Rail Corporation and held it liable to pay damages of the amount plus interest. The conflict arose from Reliance Infra terminating its contract to operate the Delhi Airport Metro line in 2012. Ford has decided to stop manufacturing vehicles here in India. In a major blow to the Indian auto sector, Ford announced the closure of its Chennai and Sanand factories with immediate effect. The company has made it clear that the sales of its Endeavour, EcoSport and Figo models will stop as soon as showrooms run out of inventories. Ford has promised full service support for its current customers. The move will result in 4,000 Ford employees being laid off. The reason Ford has given for this extreme move is the $2 billion in losses it has posted over the past 10 years. It had written off $800 million in assets in 2019. Ford is the second US auto company to exit India after General Motors. Ford says it will continue to make engines in India for export as well as maintain its business solutions team in India, which has around 11,000 employees. The company will also import high-end cars like the electric Mustang to India.
This restructuring is in response to increasingly challenging market conditions, including the extended slowdown of India's auto industry, as well as cumulative operating losses of about $2 billion. In the time to come, Ford will shift from an existing set of locally produced products to a global portfolio. I want to be clear that we are not leaving and will continue to take care of you like family. We will be working closely with our dealers to ensure accessibility of service and spare parts, quality of service with a family wali feeling, competitive cost of ownership, and the honoring of our warranty promise.
So what's the immediate impact of the Ford pullout from India? Number one, uncertainty among Indian car manufacturers. We've got a lot of Ford car owners here. There will be a continued uncertainty amongst them, even though the company has assured of service and spares. The prices of Ford cars in the used car market as well will tumble. Number two, 4,000 employees to be jobless, and that's just ahead of festive season. Number three, suppliers, ancillary industries, all will take a hit. Number four, lower competition in the mini SUV segment with the EcoSport no longer on sale. And number five, with the exit of Ford, Jeep is the only remaining US brand that's now here in India. Well, sticking to the auto industry, in a major embarrassment for the company, Ola Electric has been forced to postpone the sale of its highly anticipated electric scooters. The S1 and S1 Pro e-scooters will now be available only after September 15th. The company, however, assured buyers that this will not delay its deliveries. The postponement was on account of glitches in its website. Ola founder and CEO Bhavish Agarwal, in a tweet late on Wednesday night, apologized to buyers. Zerodha has been one of the amazing success stories of the financial sector in India. Started in 2010 by two brothers, it's today the biggest brokerage in the country. Business Today's global business editor, Udayan Mukherjee, spoke to Nikhil Kamath, one of the co-founders of Zerodha. Listen in.
You're the star today, you know. You, as I said, I mean, you dropped out of school and you probably bumbled your way around a little bit, and look where you are today, a billionaire. How does it feel to be a billionaire in your mid-30s?
Well, Udayan, it's one of those things which, I mean, it sounds good at the very beginning, but I think it also has its pluses and minuses. Not something we pay attention to too much. You know, we're paper billionaires, so it's a valuation metric of somebody multiplying how much profits your company make in a year into X. So don't really pay too much heed to it, and we are very cognizant to the fact that we're in such a cyclical business where you know, at any point the markets can correct 30-40% and be in a bear run for a couple of years, and we lose 50% of our revenue instantly. So it is nice, and it is complementary to all the hard work many people have put in, yeah.
Has it changed your life though, Nikhil, significantly? Because, you know, I read somewhere that you like fast cars, you drive big bikes. Has life changed, or do you remain a fairly regular kind of guy?
Well, I think fairly regular. When I was younger, there was a time when I bought one bike and a car, but not anymore. And also, I live in Bangalore, Udyan, so it's in my mind the traffic in Bangalore is probably on par with Delhi or even worse. So you don't really have the opportunity to drive a car here and really enjoy it. So not really, and I'm I'm kind of now working from home, so I don't even get out of the house, unless it's like once in a week or once in 10, 15 days.
Yeah. But I do want to just address the Zerodha bit because this has been a remarkable success that you've pulled off. What did you think? What do you think you've done differently compared to the existing model which was in place for many years? The usual ICICI Directs and HDFC Securities of the world. How could you shake up these systems quite so easily? And do you think you'll manage to keep your edge in a fairly competitive space?
Yeah, so when we began, our biggest USP was transparency and the fee structure, of course. We were traders back then, both me and Nitin, and we had to pay as much as 0.5% in brokerage and still have a fairly shoddy service where you didn't really know what your broker was charging and why. At the very beginning, the cost advantage, the fact that we charged a 20 rupee flat fee versus somebody who was charging 0.5%, it made a bigger difference on derivatives where people were speculating because they were speculating with leverage. And this 0.5% on a levered product, people ended up paying more money than they make trading in just brokerage.
And do catch that full interview tomorrow night here on the Business Today show. That's at 10:30 p.m. Nikhil Kamath in conversation with Udayan Mukherjee. That's all we have time for on the Business Today show. Thanks so much for joining us. Do stay tuned. Lots more news coming up. Good night.